When I was 28, I made a financial mistake that still haunts me. I had just come into a small inheritance, $10,000. And instead of putting it to work, I let it sit in a savings account, untouched, earning next to nothing. Fast forward 3 years, inflation had quietly eaten away a chunk of its value. And I realized something painful. I didn't lose money by making a bad investment. I lost it by doing nothing. That's when I stumbled into the world of dividend ETFs. Today, I'm going to show you the 10 dividend ETFs I wish someone had handed me back then. These aren't just ticker symbols. They're the foundation of what I now call peace of mind wealth. If you've ever felt like investing was too risky or confusing, this video will change the way you think about money and your future. And if you've already dipped your toes into the market but don't know how to build consistent long-term income, this might be the most important 12 minutes you spend this week. We're not just listing ETFs. We're breaking down why these exact funds are built to last, what makes them different, and how you can match the right ones to your lifestyle, whether you're hustling in your 30s or preparing for freedom in your 40s. Stick around because near the end of the video, I'll reveal one ETF with a unique strategy that doesn't just grow your money. It shields it during downturns. Most people overlook this fund, but it might be the smartest thing you add to your portfolio this year. You're watching Golden Goals. I'm Mike, and we're about to change the way you build wealth forever. Why dividend ETFs equals wealth freedom? Let's start by breaking a myth wide open. Investing doesn't have to be complicated. You don't need to be glued to charts, gamble on meme stocks, or guess what the market's going to do next. In fact, the real secret behind most financially free people isn't flashy. It's steady, it's boring, and that's exactly what makes it brilliant. Dividend ETFs are one of the most powerful tools for building wealth because they combine two things that rarely come together: growth and income. They give you exposure to a wide range of successful companies, tech, healthcare, energy, you name it, while paying you cash flow consistently. That means you're not just hoping your portfolio grows someday. You're getting paid along the way. Think about that for a second. What if every month your investment sent you a check? Not from some risky scheme, but from owning slices of companies like Apple, Microsoft, and Johnson & Johnson. That's the power of dividends. And with ETFs, you don't even need to pick the winners yourself. You let decades of data, smart fund design, and world-class asset managers do the heavy lifting for you. But there's more. Dividend ETFs also shine where it really counts for long-term investors: low fees and tax efficiency. Many of the funds I'll show you today have expense ratios as low as 0.03%. That means more of your money stays working for you. And because these funds are structured to minimize capital gains distributions, you're not giving Uncle Sam more than you have to either. For younger investors, those in their late 20s, 30s, even early 40s, this strategy is gold. Because the dividends you earn now, you can reinvest them. And that reinvested cash quietly compounds over time, snowballing into serious wealth while you focus on your life. That's why I call it wealth freedom. Not the kind that flashes dollar signs overnight, but the kind that gives you choices 10 years down the line. And trust me, choices are everything. What makes these 10 ETFs unshakable? And so what separates these 10 dividend ETFs from the hundreds out there? Why are they the kind of investments you could hold through thick and thin and still sleep like a baby? It boils down to 3 traits: consistent income, broad diversification, and market-tested resilience. First, consistent income. These ETFs are filled with companies that don't just pay dividends, they grow them. That means the check you get this year might be bigger next year and even bigger the year after that. That's a powerful hedge against inflation and an even more powerful engine for reinvestment. You're not relying on hype. You're relying on cash flow. Second, diversification. These aren't single stock bets. Each ETF holds dozens, even hundreds of companies, spreading your risk across industries, geographies, and sectors. You're not tied to one trend or one company. If tech dips, maybe healthcare rises. If real estate cools, energy might shine. It's like having a financial ecosystem that self-balances and keeps moving forward. Third, and this is big, resilience. The ETFs I've chosen have weathered everything from the 2008 financial crisis to the COVID crash. They're built not just to survive, but to recover and grow. Many of them include dividend aristocrats, companies that have increased payouts for 25 plus years straight. That means they've been sending income to investors through dot-com bubbles, recessions, and everything in between. Bottom line, these ETFs aren't just safe picks. They're battle-tested vehicles that reward patience, consistency, and strategy. And now we're about to dive into each of them, breaking down the unique edge they bring and how you can fit them into your own portfolio like a pro. Let's start with a fund that's gaining massive popularity for a reason, and it's not what you think. The 10 best dividend ETFs you'll never sell. Let's break down the stars of the show. These aren't just popular tickers. These are funds handpicked for their ability to work for you, day in, day out, whether the market's soaring or sliding. First, JEPI, JP Morgan Equity Premium Income ETF. This ETF is like the multi-tool of dividend investing. It holds solid, large-cap names like Microsoft and Apple, but here's where it gets clever. It also uses a covered call strategy to generate extra income. That's how it pulls off a yield of 8 to 9%. JEPI isn't about chasing growth, it's about stability, income, and hedging volatility. If you're looking for a monthly paycheck without panic during market swings, this is your guy. Second, PFF, iShares Preferred and Income Securities ETF. Think of this one as a bond stock hybrid. It invests in preferred shares from companies like Wells Fargo and Bank of America, offering a steady 6 to 7% yield. The price doesn't move much, which is exactly what makes it comforting. If your goal is dependable income, PFF is your financial heartbeat. Dry. SCHD, Schwab U.S. Dividend Equity ETF. This ETF has built a cult following, and for good reason. It tracks high-quality companies that have increased their dividends for at least 10 years. The result? A juicy 3.9% yield, only 0.06% expense ratio, and 10.26% 10-year return. It's like a reliable old friend, consistent, low-cost, and strong through the years. Fourth, FDVV, Fidelity High Dividend ETF. Want exposure to energy and financials? FDVV focuses on large and mid-cap stocks with solid dividends. Think ExxonMobil, Chevron, and JP Morgan. You get a 3 to 4% yield, backed by diversified sectors with long-term upside. It's a smart play if you want income plus the potential for appreciation. 5. VYM, Vanguard High Dividend Yield ETF. Broad exposure, ultra-low cost, and rock-solid brands like Johnson & Johnson and Exxon make this a classic. With a 2.84% yield and 0.06% expense ratio, it's built for those who want dividend income with a side of quiet confidence. Over 10 years, it's delivered nearly 10% annually. Sixth, SDY, SPDRS&P Dividend ETF. Here's the thing. SDY only includes companies that have raised their dividends for 25 years or more. That's serious pedigree. With a 2.5 to 3% yield, it's a conservative choice, but one that rewards consistency. If you want peace of mind during rough markets, SDY delivers. Seventh, DGRO, iShares Core Dividend Growth ETF. Think younger, leaner, and hungry. DGRO includes companies with a history of increasing dividends but also room to grow, like Apple and Microsoft. You get 2 to 3% yield, low fees, and potential upside from both income and capital gains. Great for a younger investor with a long runway. 8. VIG, Vanguard Dividend Appreciation ETF. Another gem from Vanguard. It tracks the S&P US Dividend Growers Index, meaning companies that consistently raise dividends. Same yield ballpark as DGRO, but a slightly different flavor of quality holdings. Great for anyone wanting balance between growth and reliability. 9. RDVY, First Trust Rising Dividend Achievers ETF. This ETF focuses on companies that recently started raising dividends. That means it might not have aristocrats, but it has momentum. With a 3 to 4% yield, it appeals to investors looking for growth and rising income in the same package. Vanguard SEP Pinset ETF. Now this one's different. It's not dividend-focused, but it deserves a place on this list because it tracks the S&P 500 with a tiny 0.03% expense ratio and a 1.5% yield. What you sacrifice in income, you gain in long-term capital growth and a market-wide exposure. This is the backbone ETF, the game changer. This ETF strategy is built different. Let's zoom back in on JEPI for a second, because this one does something the others don't. And if you're serious about passive income or recession-proofing your future, you need to understand why. Most dividend ETFs rely solely on the company's inside to pay out income. JEPI adds a second layer. It writes options, covered calls, on its holdings, which brings in extra cash every month. That's why it can deliver an 8 to 9% yield, even in sideways markets. Here's a quick example. Imagine owning a rental property that pays you $1,000 a month. Now imagine if you could rent out the driveway too, for another $500. Same property, more income. That's what JEPI does. It's not a get-rich-quick fund. But if you want consistent cash flow and you're concerned about volatility eating into your returns, this strategy gives you a powerful edge. It's different, it's disciplined, and it could be the stabilizer your portfolio needs. What I wish I knew. At 25, the power of reinvested dividends. If I could go back to my 25-year-old self and whisper one sentence, it would be this: reinvest every single dividend. You see, most people treat dividends like a paycheck, and yes, they can be. But when you're young or even just getting started, that cash is your rocket fuel. Every reinvested dollar buys more shares. Those new shares pay their own dividends, and over time, that snowball becomes unstoppable. I'll never forget the first time I ran the numbers. If you invest $500 a month into schd and reinvest your dividends, in 20 years, without doing anything fancy, you could easily cross 6 figures, and that's assuming no big salary, no inheritance, no lottery ticket. Just discipline and time. The biggest mistake younger investors make is thinking they have to choose between income or growth. With dividend ETFs and the power of reinvestment, you get both. That's why these ETFs are not just investments. They're building blocks for freedom, flexibility, and financial peace of mind. Let's do a lightning-fast recap of what we just covered, because if your mind's spinning with tickers and yields right now, I've got your back. We started with the power of dividend ETFs, how they generate income, reduce risk through diversification, and grow quietly but powerfully over time. Then we explored 10 ETFs that you can truly hold forever. JEPI for high-yield income and downside protection. PFF for bond-like stability and regular cash flow. schd for growth, consistency, and cult-level performance. FDVV for sector-based dividend strength. VYM for low-cost exposure to reliable dividend payers. SDY for the aristocrats of income. DGRO for younger, high-growth dividend companies. VIG for consistent dividend growers. RDVY for rising payout potential. VOO for broad market exposure and core portfolio strength. Now, I want to play ETF matchmaker for a moment. Ask yourself these quick questions. Want maximum monthly income with stability? Start with JEPI and PFF. Want to grow your portfolio while building passive income? Check out SCHD, DGRO, or VIG. Need a safe, broad market, long-term play? VYM and VOO are solid anchors. Looking for a combo of rising income and growth? RDVY could be a perfect middle ground. And remember, you don't have to pick just one. Great portfolios are built like teams. Each fund plays a role. You're not chasing hype, you're assembling a reliable crew that works while you sleep. So here's your golden goal for today. Pick one of these ETFs, just one. Research it, invest something, anything, and set up automatic reinvestment. That tiny action could change everything 10 years from now. If this video helped you, I'd love for you to hit that like button and subscribe to Golden Goals. I've got more smart investing strategies, real stories, and tools coming your way every single week. We're in this together. Thanks for watching. I'm Mike, and your future is worth investing in. I'll see you in the next one.